In today's video, we're going to be covering the SEP IRA and the solo 401k, otherwise known as an individual 401k. If you are self-employed, one of the biggest opportunities that you have is creating the right retirement plan. This is because the plan that you choose doesn't just impact how much you save. It impacts how much you actually can save, how you're taxed, and what the flexibility looks like when you're looking to make distributions. The most common options are between the SEP IRA and the solo 401k. In today's video, I'm going to cover the key differences between the two, when each one makes sense, and why in most cases I prefer the solo 401k. Let's start with the basics. Both the SEP IRA and the solo 401k are designed for small business owners. They both allow you to make tax-deferred contributions, which directly reduces your taxable income. But where they differ is in how contributions work. With the SEP IRA, contributions are made as the employer. With the solo 401k, you're actually wearing two hats. You are the employer, but you're also the employee. As the employee, you can defer a portion of your income. And as the employer, you can make a profit-sharing contribution. When you combine those two, you're often able to contribute more, especially at lower income levels. So right away, the solo 401k gives you a bit more flexibility in how you contribute. The next big difference is Roth contributions, and this is a big one. With the SEP IRA, all contributions are pre-tax. There is no Roth option. With the solo 401k, you have the opportunity to contribute Roth on your employee contributions. What this means is that you're choosing to pay taxes now for tax-free growth later. And that flexibility can be extremely valuable for your tax situation. Another key difference is regarding backdoor Roth IRA strategies. If you are doing or considering doing backdoor Roth IRA contributions, SEP IRAs will complicate this. This is because SEP IRAs are subject to the pro rata rule, meaning that each conversion that you do could be taxable due to your SEP IRA balance. Solo 401ks completely avoid this issue. They are not subject to the pro rata rule. This makes solo 401ks even more flexible from a tax planning standpoint. Now let's talk about loans. Solo 401ks often allow for participant loans. SEP IRAs, on the other hand, do not. Now that doesn't mean that you should plan on borrowing from your retirement account, but having that flexibility can be really helpful in some situations. The next difference is regarding administrative complexity. SEP IRAs are extremely simple and easy to maintain. There is very little paperwork and they're really easy to manage. Solo 401ks are a little bit more involved on this front. There's more setup up front, and once the account reaches a certain size, right now being $250,000, you will be subject to file form 5500 easy. Now with all that said, why do I generally prefer the solo 401k? It all comes down to flexibility and control. The ability to be able to contribute more at lower income levels. The option to continue making Roth contributions. Better compatibility with strategies like the backdoor Roth IRA. The ability to get a loan from the account if need be. All of those together typically make the solo 401k the more versatile option. But that doesn't mean it's always the right choice. If you're self-employed and you're not sure which option makes the most sense for you, it's definitely worth your time to evaluate it carefully. And if you would like some guidance on making that decision, feel free to reach out. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.